Thanks for tuning into today's Talking Point. I'm your host, Neeraj Shah. Our guest today was skeptical in the markets sometime in 2022, somewhere around March 2023, in another conversation which is with us on BQ Prime. He spoke about how the markets or the streets seemed to be overly pessimistic and maybe it was time to be tactically bullish. Proved to be prescient then as well. Since then, the markets have rallied. So we thought now at this crucial juncture where there seems to be a bit of an indecision for world markets as well as the India markets, we thought it's best to get his opinion on how he sees the current markets from his context. Rajesh Bhatia of ITA Mutual Fund joins in right now. Rajesh, great having you. Thanks for taking the time out.
Thank you, Neeraj. Always a pleasure to be talking to you.
Thank you. So, Rajesh, what's the sense currently? Because there seems to be a lot of moving parts, as they always are. But because these moving parts are coming at a point of time when the markets, if not at all-time highs, are just shy, 3-4 percentage points away from the all-time highs.
Yeah, so I think it's always good to get a context. And I want to talk about this because I don't think it gets talked about enough. Markets are driven by two factors, earnings per share and price earnings ratios, right? As fundamental analysts, we tend to focus more on earnings per share. And rightly so, because, as the saying goes, markets are slave to earnings. So if earnings go up over time, stock markets also kind of go up. And that's where the focus on EPS more than PE. But what's interesting for me to observe is that more in the recent times, maybe a function of how the top 10 central bankers have impacted asset prices by shoving in a lot of liquidity in the global markets. I think price earnings ratios have become an equally important determinant of the markets. Let me kind of give you some context. There was a collapse in, let us say, the US 2-year Treasury rates starting March 2020. It collapsed quite sharply. And guess what happened? Our markets, even during COVID, where there was low visibility of earnings per share, went up for 16 months or so in a row. It was a re-rating or PE re-rating of the entire equity asset class, even though there was low visibility of earnings per share. Now, the US 2-year Treasury remained flat for a long period of time until, guess what? September, October of 21, exactly at the time when our markets peaked. And from there on, they have rallied quite sharply. What happened to us? Our markets were at best flat for closer to 20 months. Again, when they started to kind of move down, guess what? When? March 23, our market started to kind of rally. And more recently, again, due to inflation concerns, the interest rates in the US have started moving up. What has happened to us? Again, we have gone into consolidation. So the point I'm making is, first, it is a little underappreciated, and that's why my observation that how much these markets are now macro-driven and PE-driven, price earnings driven. And therefore, I think as you move forward, the first thing you have to kind of consider as analyst is that this is going to be a volatile equity market based on assessments of where cost of capital is going. So that's the first thing I wanted to kind of make an observation on. The second thing is, of course, India is looking extremely good in the entire global environment. Every economy like China, Europe, Japan, or US are slowing down or are going to slow down, right? And they have structural challenges of demographics, etc. India is looking for a $3.5 trillion economy, the best poised for growth for the next 10 years. Somebody would say it is the most predictable story in the world where such a large economy is predicted very clearly to grow at the fastest pace for a long duration of time. Having said that, I think there is an expectation that we are going into a 2003 to 2008 straight rise phenomena. Neeraj, if you recollect, we kind of bottomed out in 2003. I think the Sensex went up 7 times during that 5-year period. And the last 3 years of 2003 to 2008, the GDP of India was at a record 9% growth rate, right? But you would recollect that it was helped a lot by the global growth factors. So every country in the world was growing. In fact, you have to find countries which are not growing.
Yeah.
I think there was an exception of Zimbabwe or something. But other than that, every single damn country was growing, and India had a phenomenal tailwind from global growth. But as I'm pointing out, there is a challenge of global growth moving into the next year. So I think this bet that India will go and experience the same 2003 to 2008, well, everything is a probability as far as forecasting the future is concerned, but the probability of that is relatively lower. I am in fact more observing that economic recoveries are also a little uneven, as we move forward. So in that context, of course, we have gone up and are slightly expensive, I would say, as a market. Not exuberant yet, but certainly slightly expensive. And I would say that it's not easy to find value at this moment in the markets. Having said that, like I said, there are a lot of buyers for India because of the cleanest and the most predictable story for India. So it's better to stay invested at this point of time. But clearly, as a fund manager, we are grappling to find value.
So would it be safe to say that while you are dancing in the party or participating in the party, you're not quite dancing near the door as yet? There is still some time for that.
Yeah, I mean, I think one of the measures that I use apart from valuations is sentiment. And when does sentiment go a little crazy? And it can happen very quickly if the market starts moving up in gaps. But I think the sentiment, there is still cynicism, skepticism in the professional world, at least, although the retail participation is extremely exuberant. I would say that there is still good enough skepticism in the market for me to feel that we are reaching our peaks of the markets.
Okay.
So not yet.
Okay. The other part, a follow-up to one of the points that you made, yields moving higher. There is the opinion this time around on yields moving higher is divided, wherein some people are very strongly believing that it's not happening because of inflation expectations as much as it's happening because treasuries worldwide, maybe because Japanese are seeing more value in their markets, maybe China is having to do that. But the dumping of treasuries, the US treasury happening, is probably the reason why the yields have moved up and not necessarily only inflation. And as a result of which, at some point of time, this will even out as well. Your thoughts?
Well, it is technical factors versus fundamentals. I think I would look at a little more of the fundamental factors, as we speak. I think the challenge is that suddenly people are finding out that inflation is not so easy to bring down, particularly in the United States. And that because of the full employment situation in America, that the economy continues to be strong. And unless greater measures are taken to kind of bring down inflation, which is by way of interest rate rises, inflation is going to still be sticky. I think a lot of companies during the COVID period, when they were recruiting, found it extremely difficult to recruit people. So they are less willing to let go of people, even if there is a bit of slack. So that's the reason why inflation continues to be kind of sticky in the US. Having said that, there are a lot of people in the US and otherwise who believe that given the banking challenges in America and given the commercial real estate problems, that banking will slow down. There will be global factors like China, which will slow the economy down. And hence, that interest rate cuts are probably a year away or somewhere around there. And that's more likely to happen over a period of time rather than steep, sharp increases in interest rates from here on. So maybe there is a interest rate 25 or 50 basis points interest rate increases as you move forward. But observers eventually believe that interest rates will kind of come down as you move forward. And that's why the kind of still a sober assessment of asset markets.
So therefore, Rajesh, just to round up this point, based on whatever you believe is the likely probable outcome, who knows what the actual outcome will be, of course, do you reckon that, what do you reckon could be the global move and what the impact on India could be? So I heard you say that there is the P multiple angle, which is a global macro driven angle, but India has buyers and India is the most predictable story. So from here on, staying invested is a good idea, yes. Can the markets do more? The reason I asked this, for example, is because a recent note from one of the brokerage houses was that US is not going into a recession. that would mean tailwinds for sentiment and therefore tailwinds for India, and their target is 20,500 by December. I'm just trying to understand, how do you think about this global picture therefore?
So these things are very difficult to forecast. I mean, I'm not going to forecast this. I just try to understand where we are rather than forecast it. And given where we are, of course, I think the observation that US is not yet going into some kind of a deep recession as much as we thought, as quickly as we thought it would, that observation is correct. And that's why the benign asset market environment globally, including in the US, and India kind of continues to chug along. Having said that, I don't think that the economic momentum, minus a few kind of pockets, is very strong in India either. I don't think consumption is that strong. Exports is that strong. The rural economy is in such a great shape. So there are pockets of weakness in our story as well. And I think that is really where we need to focus on, as we move forward. Whether our economic momentum is reasonably strong, and how to play that.
Got it. Okay, Rajesh, one quick follow-up question. Jan 2023, because of an external Hindenburg report, there was a major impact at the broader end of the market sentiment, if you will, and of course the Adani Group stocks and a few others. Now my question is, there is this, I don't know if you have a view here, but I'm asking you that there's this possibility come about yesterday, which we published as well, that OCCRP, a global foundation, etc., might be doing another expose, so on and so forth. I'm just trying to understand, back then, Indian markets were unprepared for something like this. Now we've seen an event go by and recouped the losses as well meaningfully and sentiment meaningfully. Can something like this hurt the Indian markets with equal gusto at a point of time when I hear you say that there are a lot of people who are wanting to buy into India?
So I think, the familiarity of that event is probably going to mean that any risk aversion that comes will be localized to that particular group. I mean, I don't have an opinion on that group in any form, but to me, it appears that even if there is some kind of acceleration in that kind of some kind of investigation or exposure, etc., it will be localized to that group rather than to the entire market. See, listen, I think what is good to observe in the Indian markets is the breadth of the rally.
Most certainly.
And that makes it an extremely good quality rally. So unlike in the US, where 7 stocks are driving the entire US markets based on one theme, artificial intelligence, those 7 stocks, if I'm not mistaken, now are 25% of the entire US market. It's an extremely lopsided and one-sided market. In India, if you look at it, autos rallied, NBFCs rallied, banks, pharma, capital goods, various themes like defense, all of that. So the breadth of participation, in my observation, whenever the breadth of the rally is so broad, the quality of the market is really good. Sure. And that's why I believe that it's these things don't dissipate very, very quickly unless there is some real serious risk aversion that comes from the global market. These rallies don't dissipate that quickly, and the quality of the rally is quite healthy for India. In fact, that's also something that is very encouraging for me. When we look at various sectors in the as analysts in the country, everything has a very powerful 5 or 10-year theme. So whether it is even hospitals, you would think that India is a very, very young country. But the number of people who are moving to 50 plus means that the need for good quality healthcare and hospitals is a huge theme as well. I mean, who would have thought? People mostly were focusing on how premiumization of the younger customers is a great theme. That is great, definitely a great theme. But even as diverse and opposite to that, which is aging population needing healthcare, is an equally powerful theme. So there are just so many themes in India which you can play as growth stories for the next 5 to 10 years. Makes me extremely excited that we are at the right place at the right time as far as India is concerned. Having said that, a lot of people are seeing the same thing, and because of which Indian markets don't tend to get cheap.
Yeah, that's true. And therefore, my next question, Rajesh, because you guys keep on getting in newer funds every month, right? Or every day, every week, every month. I heard you say that they are great market to stay invested in, but which doesn't mean that you are gung-ho about putting large swaths of money to work. So my question to you is, where is it? I'm guessing that you are bottom up currently in select pockets where you might be deploying fresh capital. What are those areas wherein you guys as a house are comfortable deploying or putting more money to work at the current point of time?
So Neeraj, you're absolutely right. I think if I look at it, I think we are not going to do sector-based investing, but now we'll have to go into stock-specific investing. And again, we are finding so many areas where we can kind of put or deploy money. Now, I think on a broad basis point, I would say that banking, consumer, oil and gas, particularly one large company, and FM, IT. These four sectors are probably 60 or 70% of the market. Now, given where they are, given the narrative on these sectors, I don't think these are going to be very large movers in the shorter term and a big driver of markets. So I think now we have become a more sector-specific, stock-specific kind of market rather than a sector mover kind of a market, right? So one thing is that we are kind of moving towards more stock picking orientation. One of the things that we kind of feel, given the point I made earlier, which is Indian markets are rarely cheap, right? Because of the kind of narrative that we have. What has worked for us usually is contrarian investing. Let me give you the example of, let us say, what happened to insurance companies post the budget. There was an increase in taxation for certain products of the insurance companies, because of which stocks fell about 20 or 30%, right? And we felt that based on our conversations with distributors and the companies, that this is unlikely to have a significant impact as much as the markets had kind of priced in. And these were great franchises. I mean, insurance is sold through banks, and no surprise then, bank insurance and therefore large banks dominate this sector. So we use that as an opportunity to kind of buy those stocks and where the risk return was more favorable. So I think it is going to be a stock-specific market as you move forward rather than a big sector-based driven market. And second, I would say contrarian investing is working best for us, as you move forward.
Okay, so insurance is a good point of time around the budget. Is there some contrarian possibilities? I mean, I see some insane gains in pockets which have had the promise of book to bill, etc. So if anything, I would feel that if somebody is contrarian, they might be contrarian short on some of those promising themes. When you talk about contrarian possibilities, what are the areas currently? I know, sorry, Rajesh, standard disclaimer, I know you can't talk stocks, and I know that you are doing bottom up, but I'm still trying to understand what are the themes wherein with these stocks might be lying.
So an example that comes to mind is, let's say, the two-wheeler sector, right? So this is a sector that has been impacted by, a lot of sharp rises in cost of the vehicles thanks to emission norms and ABS, etc., etc. So the cost of the products went up probably 30% or thereabouts, right? Second, the consumers of these vehicles, Bajaj Auto recently pointed out that 70% of the customers earn 40,000 rupees and lower. This class was impacted by the COVID. So the peak industry volumes that you saw in the two-wheeler business, let's say in 2019, was about 2 crore vehicles, thereabouts. And right now it's about 1.5 crore vehicles, thereabouts, right? So now this customer base is taking time to absorb those cost increases and absorb their COVID challenges. But it's going through this cyclical kind of grind and eventually will emerge, right? And there will be a replacement demand in two-wheelers, etc. Also, the export prospects for two-wheelers in India is extremely exciting, right? So there are a lot of countries which are at very early stages of two-wheeler adoption. So, and these companies are extremely profitable. The two-wheeler companies have very good dividend yields, probably 5% dividend yields. And therefore, you're buying them at a lower point of their cycle. And as you move forward, it would be a damn good consumption play. consumption stocks are so expensive. I would say that on a contrarian basis, two-wheeler companies with domestic and export prospects makes enormous sense. So that's one kind of idea of a contrarian investing that you could do.
Got it. Okay, Rajesh, one nugget of wisdom before I let you go. I want to understand how you think about some of these pockets which have rallied quite strongly in the recent past. If I look at purely FY24 P multiples, they look exorbitantly expensive, but their book-to-bill ratios are extremely strong, and the government focus on those sectors is very buoyant. So, the electronic manufacturing companies, the railway companies, which see no end. For all the pain that they've endured in the past 15 years, the last 15 months have been terrific for them. Then the defense names, which again seem to be getting orders by the dozens, and the prices keep on moving up despite the execution not quite there yet in select cases. So how do you think about these 2 or 3 pockets? There might be more, but I'm using these as illustrations.
No, I think what you're pointing out, Neeraj, is the Make in India strategy and how that is going to evolve. We have been speaking to a lot of companies. Fortunately, there have been a lot of conferences, in the city, and we've been speaking to a lot of companies. And one thing that comes across very commonly is how proactive this government has been in kind of promoting Make in India. That is phenomenal to see. There's a healthcare company, hospital company that we were speaking with, and they brought up this topic of medical tourism. They were telling us that, earlier a patient had to go to a police station if he came from, let us say, abroad for medical tourism, right? Every 7 days or thereabouts, he had to go to a police station to kind of report if he came for medical tourism. The government has made sure that all of these processes are ironed out, and he felt that medical tourism could really flourish thanks to the government support that they're getting. We were speaking to an EMS company, and they were telling us, the government actively monitors imports of what comes into the country. And when they see some rise that is taking place, they come back to the industry and ask them, how can we make this domestically? And what is it that you guys require to ensure that we do this in the country? So I think that the government support that you're going to have, of course, the same with defense, etc., is going to be enormous in the Make in India story. And I think these are going to be very good themes as you move into the future. It's all going to be about execution. But unfortunately, like I pointed out, themes which are known don't get priced at attractive risk returns. So is Make in India and these themes going to be very good in the future? I think so. Are these going to scale enormously? Definitely, that's my belief. What Maruti brought to the automobile industry, the change that it brought in the auto ancillaries, and with the result that several auto ancillaries became global champions like Bharat Forge, Motherson Sumi, the entire Sundaram group, etc., and Maruti became an exporter of cars. What happened to that auto ecosystem is going to happen to the electronic ecosystem, is going to happen to the defense ecosystem, etc. So we are extremely positive on this Make in India, into the future. Stock picking, that's another matter.
Okay. Sometime between this conversation and the next one, Rajesh, we'll try and understand from you, how do you think about this very aspect, how to pick those stocks without getting into names, but how do you think about some of those things and how do you pick those stocks? That'll be a lovely conversation to do as well. Thank you today, though, for giving us a lowdown on the global macro and the resultant impact thereof, and some of the micro as well. Really appreciate your time.
Thank you so much. Always a pleasure.
Yep. Likewise, and viewers, thanks for tuning into this edition of The Talking Point.